All right, folks. What happens if you have an unincorporated entity? Okay. So the default, if you have an unincorporated entity, these are the defaults below. So if you have multiple owners, you're taxed as a partnership. Okay. So the income goes individually to the partners. If you're a single owner, individual, you're taxed as a sole proprietor, and it's going to be on Schedule C. This is part of the 1040. Okay, regular tax return. Okay, and if you're a single owner entity, disregarded entity, it's reported on the owner's return. Same way. Now, you do have an option. Unincorporated entities can elect C corporation status or S corporation status for a corporation, okay, by filling out Form 8832. Now, if you're a sole proprietor, you have to be a single member LLC. Now, why that's important, this has to do with benefits for retirement planning, fringe benefits, or for equity investment and growth. So this is kind of long term. So usually what happens is if somebody thinks they want to be a Schedule C, they have this long-term vision as to what they're going to do. Oftentimes they go through a series of steps where the entities change. They move from one entity to another. It's not always starting out at the final entity. Okay? All right, so here, let's take a look. Here, it's kind of a decision tree. Okay? So we'll start up here at the top. And it says, is the entity a legal corporation? Let's go down the yes side first. Okay? It says, does the entity qualify for and elect S corporation status? Okay? Election form 2553. That's the form that you fill out that election on. If the answer is no, they're not going to do that, then they're going to file form 1120. This is the corporate return. Okay? Corporation return is an 1120. If it's an S corporation, it files an 1120S. Okay? By the way, this is what's called an information return. And the info goes to the individual's 1040 or the shareholders 1040. Okay, so a subchapter S corporation does not pay its own tax like a C corporation does. Doesn't have separate tax. That document tells you, they issue something called a K1, and that tells you how much is going to wind up going over to your taxes. Okay, so it winds up going over to the shareholders. Now let's go to the other side. Okay, so it says, so the answer is no, it's not a corporation. Does the entity want to be a C corporation for tax purposes? The answer is yes, and if it's yes, then it flows over here to the yes side. Okay, let's say it's no. Does it have more than one owner? If the answer is yes, then it becomes a partnership. Okay, files form 1065. If the owner is no, then it's an individual. If it is, you can be a sole proprietor right here, that form 1040. Or you could do files 1040 Schedule C. This one, if you go over no, it's the same thing. It's on the owner's tax return. Okay, and the same, by the way, the same thing would happen on the no side for the LLC. Okay, so that's basically, you have choices here, and that's why you need to talk to, if you're going to be in business, you need to talk to an accountant with experience, a CPA, and you need to talk to a legal advisor to know what is the best thing to do. That's the smart thing to do. A lot of people don't want to do it. They don't want to pay the money, and they wind up making a lot of mistakes. All right. So what about these flow-through entities? Okay, this would be partnership, S corp, LLC, that's if they decided sole proprietorship. Again, that's if they decided not to be taxed as a corporation. Notice, income allocation. The income is allocated to the owners, flows through to the owners. It's taxed on their personal returns at their personal level. So one tax, okay? Now, basis. Basis is the amount of investment you have, okay? Owners can increase ownership basis, okay? And they track how much money is invested in a capital, how much money they invested. Now, they can take tax-free distributions. Distributions are non-taxable returns of capital to the extent of basis, okay? So if you've put money in, you could take money out later on. As long as you have money invested, it's not taxed. It's just returning the money to you, okay? Now, corporations face what's called double taxation, okay? The corporation pays an entity level tax at 21%, and then shareholders pay taxes on dividends, okay? All right? So that's the difference in them. And then again, like I said, usually folks that are thinking about C Corps or whatever, they have some bigger plans down the road, okay? But oftentimes it goes through a series of steps before it gets there, okay? All right, qualified business income. This is something new, came out in 2017. 2017, this was part of the Tax Cut Jobs Act. So that's the TCJA, President Trump. All right, QBI deduction. You get a base deduction of 20%. So 20% of qualified business income you get to deduct that, less some self-employment tax, okay? All right, and health insurance. Now, of course, this has to be calculated, and the reason why is because the corporate rate is 21%. So the problem was when they made the corporate rate 21%, it went from 35% on average down to 21%. They're like, uh-oh, what are we going to do for all those people that have pass-through income? This is what they came up with. This is because of the pass-through, to make it even. Okay? This is what they came up with. All right? Okay? Now, the income has to be made in the United States. Okay? So the deduction is from AGI. It's not an itemized deduction. So it benefits both itemizers and standard deductions. And there are some limitations that apply. There's wage-based limitations. Let me move my picture here. So there's a couple limitations. Wage-based and taxable income. So the bottom line here is it's meant to balance things out between pass-through and corporations. Okay? All right. Now, there's a specified service restriction. What that means, QBI phases out for certain businesses. Okay? And basically this, notice specified service, these are like professional services, health, law, accounting, consulting, financial services. Okay? So basically what it is, there gets a phase out when taxable income before it exceeds 197 for single, or 394,000 and change if you're married filing jointly. Okay? All right? Now, if taxable income is at or below the threshold, the requirement does not apply. You get the full QBI deduction, the full 20%. So notice, planning tip. Specified service businesses should monitor taxable income carefully, as staying below the threshold preserves that deduction. Okay? So again, if this was your client, let's say your client was, I don't know, a doctor, okay? And he had his own business, right? You'd want to make sure that his salary stayed below this amount so that they could get the QBI deduction. Take the money out some other way, okay? Don't want to take it as salary. All right, folks. part 2 from chapter 15. We'll be back with another part in just a minute.